Alright guys, the US markets are starting to melt down. Now we have been in an incredible run in the S&P over the last few weeks. We went from negative to positive 12% within a couple of months. But things are changing and we are heading either towards a long overdue correction or painful collapse. Now Fed Chair Powell could be the one to burst the bubble. According to him, US stocks are highly valued. People are paying too much for American stocks and we are heading into bubble territory. Now, what goes up will come down, especially in today's environment. The trade war is not getting any better, the dollar is under pressure, and US bonds are being shunned. As mentioned before, a lot of desperate money is running to assets, and this includes gold and, of course, American equities as well. The overvaluation here is simply breathtaking and should send alarm bells ringing. Now, the PE ratio today or price earnings is reaching the extreme levels of 2020, and we all know what happened after that, a furious collapse triggered by the pandemic. In fact, US stocks are trading at a 41% premium versus the 20-year average, which is alarming. Why is a ton of money pouring into the US stock market? Now, all has to do with AI and US tech companies building all those data centers out. Additionally, there's also the hope of $1 trillion of shakedown money coming from Japan, Korea, and the EU, and that is money to be invested in US industries. However, there's a big problem. Big corporate investors are piling fiercely into stocks. They believe the party will keep going, but they have left themselves dangerously exposed. Now, they are holding only 3.9% of their positions in cash. In other words, all their ammunition has been blown, liquidity has been deployed, and if conditions suddenly flip, they can't rescue their positions. They will have to hit a panic button and sell. So realize the risk is real and the big whales are more or less empty in their money tanks. The issue now is foreign investors. Will they stay the course and continue holding their US positions? And it all depends on the dollar and how much more it can plunge. Let's remember that dollar cycles are very long. It can span over 10 years. The fall today is only less than 12 months, and the news coming out of the Fed is really problematic. Over the past 3 days, US equities have fallen by 3%. Now that doesn't sound like a lot, but listen to the words coming out of Fed Governor Stephen Moran. He's the new man on the board and he wants to push Trump's agenda at all costs. Now Moran is demanding rapid rate cuts because the US economy is about to crater. The Fed risks damage to the economy by not moving rapidly to lower interest rates. He wants larger cuts, which probably means 50 basis points minimum to reach the neutral level. But what in the world is the neutral level now? Is it 3%? Is it 2%? Or is it just 1%? We just don't know. But what we do know is how massive cuts place pressure on two key points of the entire US economy. Inflation would obviously rebound. We saw US GDP suddenly rise in the previous quarter at 3.8%. But how much of that is from forced demand thanks to the tariffs? When you cut away imports from the world, the only avenue left for many products are US goods. So the rise in GDP is heavily skewed thanks to the tariffs. Less imports and more local consumption contributes to a higher domestic GDP. And that's how to make sense of everything here. The magnitude of this stock bubble is breathtaking. We are just waiting for a nasty accident to happen, and we don't know where the black swan event will come from. We can see the worst performing asset class in the US are treasury bonds. Over the past 5 years, if you held 30-year bonds, you would have lost at least 10% annually. And it seems all the money has flown to the S&P. It has returned around 15% annually for the past half decade. But the amount of volatility there is also insane, which means the market could crash by 2, 5, or even 10% in a single day if things get dicey. We could get another April event. Now, am I saying US stocks could crash tomorrow? No, I am not. But I am saying that we are at some of the richest valuations in history despite being in this climate of pure chaos. And all it takes is for US China relations to escalate or some horrific tariff to be imposed, then the house of cards will go from wobbly to a smoking heap on the floor. The Bank of America has been tracking 20 metrics when it comes to valuation, and 19 of them are flashing over valuation. P ratios, price to book, operating cash flow, it's not looking good, guys. The US is depending on the world and the tariff war to save its economy, but things don't always move in a straight line. Trump and friends, they are walking the razor's edge here. Now, while US stocks are wobbling, Europe's confidence with the US is finally getting shaken. Now, since the Russia-Ukraine war, EU economies and the manufacturing base has been decimated. With Trump's tariffs, this just compounds the pain for EU exports. Now, in just 5 months, the EU exported over $300 billion worth of goods to the US. That's 20% of total American imports. A 20% tariff on Europe is going to crush future exports, not because the US has cheaper alternatives, but because prices across the board will just be too expensive to afford. It's no wonder that German business confidence has recollapsed again. Europe's biggest manufacturing economy just can't seem to catch a break. Now, Europe's biggest crisis stems from idealism. They are stuck believing the Americans wholesale, even today in 2025, to their own detriment. They cut away cheap Russian gas for expensive US LNG. Europe will purchase $750 billion in overpriced US energy. Imagine selling oil and gas through an ocean instead of getting supply from your direct neighbor, a truly genius move. Europe has also pledged to invest $600 billion into US industries by 2028. Now, where is the money going to come from? And even if they can raise the funds, it will directly benefit Trump's economy, not the EU. So Europe has stacked the deck against themselves. It's like playing Jenga against yourself blindfolded. The EU is subsidizing the US economy. It's a big reversal of the Cold War situation or just after World War II. Now, while the US has played horribly against China and BRICS, Trump actually has thrown down a good hand against his allies. He has managed to ring fence US markets against EU exports. Now, this is tragic, but the numbers just don't lie. EU exports saw a big decrease in Q2 of 3.4%. In July, the drop continued at 0.4%. Remember, during this same period, Chinese exports to the world were increasing. In June, EU exports to the US collapsed by a big 10%. And it's saying something because Europe is the biggest trading partner to the US. Trump's tariff war is benefiting his adversaries much more than his allies. And it's going to get worse as Trump moves ahead with his pharmaceutical tariffs. Europe is a major export of medicine to the US, so another hammer is going to drop on their pharma sector. Now, I think we can finally begin to understand the sense of frustration, the sense of desperation happening within the EU bloc. They are getting hollowed out in real time, and whether they like it or not, they have to find alternative markets to pivot to. But perhaps this is the last straw. Besson has told Europe once again to grow a spine and join the US in sanctioning BRICS over Russia, impose brutal secondary tariffs to punish Putin.
The Russians are testing the Europeans, and the European resolve needs to stiffen. They need to put everything on the table in terms of economic sanctions. That, as I told my European counterparts about 2 weeks ago, all I hear from you is that Putin wants to march into Warsaw. The one thing I'm sure of, Putin's not marching into Boston. He's not marching into Boston, so...
Now, this is such a weird comparison that I am bewildered. Of course, Russia's not going to storm into Boston, but it does confirm the benefit of a large ocean separating the United States from continental Europe. But Europe, at least elements in Brussels, they're starting to wake up. They realize that the future of trade is with BRICS. As fearsome as US tariffs are, it's necessary to position yourself where trade is going to grow. Europe is now positioning themselves to pivot towards BRICS. Now, Europe and Indonesia, which is part of BRICS, has secured a trade deal that removes tariffs on most goods. So Europe can buy stuff from Indonesia tariff-free, while Indonesia can import goods from the EU without imposing any taxes. Now, the deal will come into effect in January 2027 and will save the EU exporters 600 million euros at the least. Now, the deal is just the tip of the iceberg, And we need to view Indonesia as a gateway to greater BRICS. Europe today obviously can't trade directly with Russia. The EU also has big tariffs against China. Trying to tear down trade barriers with Beijing now will only anger the Americans. Now, how about India? Remember what Besson said. The EU needs to join him in hitting all countries that buy Russian oil with sanctions. So EU relations with India, they are also in a pickle. Indonesia is going to be a hub where the EU gets to sell to a growing population that will surpass the US sooner or later. Duties on EU cars will be reduced from 50% to zero in 5 years. Levies for EU machinery, which is an industry in crisis, will also drop from 30% down to zero. Agriculture and food products will also benefit down the road. But we need to see the layup Europe's trying to do. The future of exporting to the US is doomed. At the same time, their cost of production is so high, trying to export to China is also a problem. Now, one can imagine the EU starting to outsource their factories, their production, and even build new plants in Indonesia. BRICS is the future. Building your industrial base there makes sense. You'll get unrestricted access to Chinese inputs and cheap Russian energy. So don't be surprised if one day you see EU factories popping up in the country. VW is already planning to spend $5 billion building an EV ecosystem in the country, and the plan is to lower their cost of production substantially, and you can't possibly do it in any G7 country today. Now, besides access to raw materials and energy, Europe needs to sell to a growing market. Concentrating on the US is a poor strategy. The tariff war is going to hit domestic consumption, and Trump wants everything to be made in the USA. Now, the IMF is forecasting the biggest growth in the world through 2029 won't be in the G7. Now, sure, the US could grow by over 11%, but this was before the tariff war. Now, the US economy is an isolated, closed off market. India, China, Russia, Brazil, and Egypt will be the biggest growth engines for the world, Indonesia as well. In essence, Europe needs BRICS much more than BRICS needs the EU. So, as this trade war continues, we're going to see even more interesting shifts happen. The US is obviously trying to build their own little world in the Western Hemisphere. BRICS is consolidating, especially with India coming back to the fold, and now Europe has no choice but to start their pivot. For them, all roads leads to BRICS. But let me know what you think. Are the US markets on the brink? And just how desperate are things for Europe? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.